Happy Monday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Monday, April 1st, 2024. Hope everyone had a wonderful Easter holiday with their families. So as always, we'll start with our executive summary from today's leadoff morning note. Today's key macro event is fresh evidence of our green shoots globally theme. So the nuance there is Chinese stocks are leading gainers this morning as broad-based rebounds in official and unofficial PMI data in March signal the PBOC's panicked policy response over the past 3 to 4 months is starting to gain traction. Elsewhere, structural reforms continue to promote positive outcomes in the Japanese economy per the latest manufacturing PMI and Tonkin survey data. In terms of market implications, this is a big week of economic releases, headlined by the ISM manufacturing PMI today, global manufacturing PMIs and the JOLTS report on Tuesday, the Eurozone CPI and the ISM services PMI on Wednesday, global services PMIs on Thursday, and the jobs report on Friday. We will be looking to the data to incrementally confirm our resilient U.S. economy and green shoots globally themes, each a key contributor to the current risk-on Goldilocks market regime. Investors should not root too hard for Chinese economic improvement because that will likely cause the PBOC to ease up on liquidity provision. In fact, we remain of the belief the PBOC is likely to implement less accommodative monetary policies in the coming months. That downshift may cause a negative inflection in the trend of global liquidity. As always, we will spot and report any such critical inflections in real time to 42 Macro clients. So transitioning to our 42 Macro dashboard here. As always, we'll start with trading range signals from our friends over at Longbow. We were getting a overbought signal, overbought signal here on the 10-year nominal treasury yield. So that means bonds are oversold, getting a near oversold signal in the 2-year nominal treasury yield coming off the back of last week's, I wouldn't say over, it was somewhat of a mixed PC report from the perspective of the inflation data, but we saw what we needed to see from a month-over-month sequential perspective to get the markets not too upset, to not upset the apple cart in the fixed income markets. And then right now we have an overbought signal here on gold, so be aware of that. And then lastly, as always, we'll wrap up the questions from our community here. The questions is pertaining to the West Village Montauk effect. This is something we've been talking about in our research for a while. So just reading the question, a thought, isn't the aforementioned effect a result of government expenditures and debt increase due to short-term interest rates paid out to the affluent portion of the populace and companies alike who hold their assets in short-term instruments, and becomes a rentier class, thus spending the interest paid to them? So the actual driver behind the mentioned effect, and thus the resilient U.S. economy, is the short-term interest rate and fiscal response and growing debt from the government. So that's a lot to unpack there. Let me first start by explaining to those who are not familiar what the West Village Montauk effect is. It's something it's a economic phenomenon that we've arrived at based on my own personal experience of living in Manhattan and summering in the Hamptons for a long time. What I noticed from my own personal experience is that the people who spend the most money either on their apartments, have the nicest apartments in the city, and or spend the most money on summering in the Hamptons, traveling, this and that. Those people tend not to be the people who make the most money, but rather the people whose parents made the most money. That's usually the children of rich parents that tend to spend the highest share of their disposable personal income. And because they have a large stock of savings that they can fall back on, which means that their personal savings rate, which is a flow statistic, they can take that personal savings rate effectively down to zero and spend 100% of their disposable income on very fancy apartments, summering in the Hamptons, traveling around the world, etc. So it's typically, again, it's not the 45-year-old portfolio manager that's spending the most money in and around Manhattan. It's the 25-year-old son or daughter of a successful portfolio manager who's spending 100% of their income. So bringing this back to the broader U.S. economy, what we've noticed in our research is that the stock of savings, which continues to be extremely elevated on a nominal basis and as a share of total household assets, that elevated stock of savings has allowed households to, en masse, the aggregate statistics is allowed households to spend a greater share of their disposable personal income. And this is why we continue to see that the personal savings rate, as most recently evidenced by the February PC report, is well south, hundreds of basis points south of the pre-COVID trend, of the trend that it established prior to the pandemic, and more importantly, prior to the fiscal monetary response to the pandemic, which is as great as anything we have seen outside of World War II here in the United States of America. So just kind of getting back to the question and or series of thoughts. So we would tend to disagree with the view that the short-term interest rates and the interest being paid on short-term debt securities by the Treasury as being the primary driver of the West Village Montauk effect. It is a contributing factor of the contributing feature of the West Village Montauk effect, but the primary driver of the West Village Montauk effect is twofold in our opinion. One, we had a significant amount of fiscal monetary stimulus pumped into the economy vis-a-vis federal programs, vis-a-vis the federal budget deficit. Think about, obviously we had the jobless claims, the extension of the jobless claims, both in terms of the nominal amount and also the duration. But that was only a small portion of it. From our perspective, what we saw, just in terms of the people who are spending the most money in the economy, we had trillions of dollars of forgivable PPP loans. We had trillions of dollars or hundreds of billions of dollars of COVID-related tax breaks that found its way into the employer class. And so a lot of the money that we see sitting on the household balance sheets here is not necessarily money that is down on the low income end of the spectrum. It's actually in the middle to upper end of the income spectrum, from all these things like forgivable PPP loans, et cetera. And so this is why the stock of savings in the U.S. economy is so high. Another contributing factor, obviously, is that we shut down the economy for an extended period of time, and there was very limited travel, both business and personal, for almost several quarters. And even you can make the case for a couple of years with respect to business travel. So a lot of that money was still sitting on household balance sheets. And oh, by the way, there was also a housing boom. So a lot of investors, or not a lot of households who sold houses early in the pandemic as millennials and whatnot were moving out of cities. Those people sold houses and have yet to really been able to finance new houses because, again, the existing home sale supply continues to be quite depressed. So you have people selling houses and keeping the cash. You have things like forgivable PPP loans, tax breaks, and jobless claims, and then you just have a lack of travel and a lack of social spending on social services, spending in the services sector that really contributed to the elevated stock of savings that we continue to observe in the statistics vis-a-vis our research, which we talk about every month in our macro scouting report. So I think I've gone beating this one to beat this horse very, very dead. So we're wrapping up there. Darius Dale presenting our macro minute for Monday, April 1st, 2024. Everyone have a wonderful day out there. Best of luck this week. We will catch you back here tomorrow.